Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Avan Dabash and birthday boy Nikunj Dalmia. Look how the markets are gifting you.
I was going to say celebrations in store for Nikunj, and a year older, wiser.
Well, you know, I hope the direction of the market remains always up. Age is naturally going to go up.
Like age. Yeah. They're on the screen.
Thank you very much, guys. Thank you very much. Yes, turn 45. 50 is only 5 years away.
Wow.
Age is catching up. Feels
How
really
time
old.
flies, yeah. But no, I'm sure from the entire team of ET Now, everyone who's behind the scenes in the newsroom as well, all wishing you, Nikunj,
Thank you
very happy birthday and a great year ahead.
Thank you very much.
And seems like the markets are also not stopping, like your age. Already the SGX Nifty is what, 19,100?
You know, Aisha, today it's just a coincidence that it's end of the half year,
Yeah.
end of the month, end of the week, and a brand new series. And frankly, if you really talk about the month and the quarter, which is April to June, I mean, what a comeback it's been by the bulls.
Yeah.
It is unreal. In the month of April, nobody would have argued that Nifty would be anywhere close to 18,000. Forget a print of 19,000. And I guess April 2000 or this quarter will be remembered for all the right reasons, which is FIs, they come back, inflation, it abated, margin earning season was decent, GST collections have been strong and robust, and China in a sense did not really recover the way how global financial managers were expecting. As a result, money moved back, money which had moved into China moved back into India. So for me, what really matters is that in Q1, Nifty has registered a 9% gain, a 20% gain for the mid-cap index, and a 20% gain for the small cap index. I mean, isn't that incredible? That just tells you that it just takes few months to change the market narrative, and the market narrative surely has changed. What the all-time high on Wednesday has done, that it has once again reaffirmed that the underlying demand by global investors and the underlying demand by local investors is clearly insatiable. I mean, look at the FI flow. The fact that whether it is the block deal or GQG buying into Adani group of stocks, the appetite clearly seems to be, currently insatiable. So when you have such a powerful appetite, and when you have this kind of a strong breakout, you would say that, look, you want to be with the trend. So I'll have to say it again, stay bullish, remain bullish, stay with the trend. Trend is your friend.
Yep, and that's exactly what you were saying in the promo that we played out in the months preceding where we've reached up until now. And it's not just us compared to, what we've seen compared to some of the other indices, but across the globe as well. If you look at, in dollar terms, the markets, how they fared in Q1, yes, we've clocked in that gain of about 9.5%, which is fairly commendable given the fact that the Hang Seng, for instance, has lost out about 6.6%. It's been nothing but flat when it comes to the FTSE, the CAC. The Dow Jones has eked out a gain of just about 2.6%, and the Nasdaq, though, has managed to surpass with an 11% gain. And it's been a stellar series as well gone by. The Nifty index, of course, we know is at a record high. Ditto for the Nifty Bank. Even the broader markets have scaled up a solid 6.8%. Pharmaceuticals near a 7-month high. Metals, FMCG. So, Nikunj, everything as well is participating, and you're seeing that sectoral churn as well play out.
So you start a brand new series, and this time you start a brand new series. Even though markets are at an all-time high, the open interest is not at an all-time high. The participation is not at an all-time high. The market appetite clearly is not indicating that there is any kind of an euphoria. So you're starting a brand new series, and you've got a record print, and that record print again is not matching up with the underlying commitment to the market. So you're not starting feather light, but you're starting pretty okay. Second, what will be the differentiating factor for the July series? And I think there are two differentiating factors, or I would say three actually. The first differentiating factor is that this time around, earnings season expectations are not low. Earnings season expectations are high. So we could see volatility because of that. Monsoon. It has picked up, but if the monsoon in a sense does not progress in next couple of days, then you could really see some amount of volatility. And third, given that what we've essentially heard from the Fed in the last meeting is another rate hike coming in the month of July. So these are three variable factors which in a sense would be the differentiating factor. So June was about technicals, readjustment, FOMO and liquidity along with block deals. July could be the two new ingredients. In the July would be monsoon and the earnings season, and right at the top of the heap really would be the earnings season. So the difference between June and July, earnings season.
Yeah, absolutely. We'll have further triggers to work with. And of course, it was a busy Wednesday evening. Sebi board meet outcome. They've reduced the timeline for listing of shares. In fact, it's now down to 3 days. Subscribers who don't get shares will quickly get refunds as well. There's no plan to increase retail quota in IPOs. Sebi's also approved the like I said, the listing timeline to about 3 days for IPOs, and they've approved additional disclosure norms for FPIs as well. The board now says that they do not approve mutual fund TER norms. They've approved the proposal for voluntary delisting of NCDs as well and exempted some debt securities from listing norms as well. They've also approved the strengthening of investor grievance handling mechanism through scores to link complaint redressal system as well. In fact, let's hear out what the chairperson had to say after the board meet in her address to the media.
This was not due to paucity of time. This proposal was discussed in depth, and the board finally advised Sebi to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. And for instance, as an example, I would say, for instance, they demonstrated to us that the economies of scale over the last 5 years, which we were seeking to share with the investors, had actually happened. Now, when we saw that granular data and said, okay, we now understand this, so therefore, a lot of the things that we had built into and baked into our original proposal needed to undergo a change. Similarly, there was a lot of discussion about arbitrage funds and how they, by definition and by nature, have a lot of transactions, right? Because you're doing buy, sell all the time. Of course, on the other side, you don't need that much of research going on in an arbitrage fund, but the data came to us. And as a result of this data, which came to us from the various stakeholders, we modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore, what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we, obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore, the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different. Let's see what the feedback is.
Okay, that's the takeaway coming in from the Sebi chairperson. Of course, there was that news on TCS as well, now going to be applicable from October 1st. So it was a busy Wednesday evening.
No, see, TCS is something which has just got extended.
Yeah.
But what interesting bit for me, which has come out from that announcement from the ministry, is that it will not be applicable for credit cards. That, frankly, in my understanding, has come out as a new news, because earlier it was applicable to any transaction which happened above 7 lakh rupees. So for me, I think that's a bit of a change there, and it gets extended, which means it gets pushed back because of the back end is not ready, which means that if you've not done your summer overseas travel well this year, you'll have an advantage. That's about it. From the Sebi board meeting, and really from a market standpoint, look, IPO listing happening in 3 days, the system I think is robust now. There used to be a time when IPOs used to list, it took them more than 3 weeks. Then it came down to less than 15 days and now 3 days. And 3 days, I think, is also right. Why? Because when you're subscribing to the IPO, you're subscribing to that kind of that environment, which is the liquidity, the technicals,
Overall
and
market,
overall
yeah.
market. And normally when IPOs they list, if it's a long listing gap, the market tends to change. So valuations always tend to change. So I think this is great news that 3-day is, I think, a very decent and a very quick, and I think it would be one of the quickest turnaround in the world. I'll have to check the data, but my sense is it would be one of the sharpest in the world. The interesting bit from a market standpoint would be the Sebi chairperson has said that we've taken feedback from the mutual fund industry when it comes to the TR charges, and we will be coming out with new norms, and the mutual fund industry should be happy. There's a fear in the market that if the new TR norms would be implemented, it will lead to a large loss for at least large AMCs which have a large equity exposure, HDFC, SBI and others. Looks like there could be a relief there. That means that today I will not be surprised that if an HDFC AMC and a Birla AMC along with UTI, they see some recovery. Because now you know that what markets were assuming, that kind of an TR rate change is not going to be happening. If that will not happen, better profitability. So the theme today, apart from autos and banks and Nifty dominated stocks, really the side theme today could be comeback in AMC stocks.
Oh, yeah. Yes, indeed. A lot of highlights coming in there from that Sebi meet as they are looking to promote transparency as well as promote investor confidence. But that aside, as we told you, the rest of the globe started off on a fairly healthy note, but it's interesting to also track what exactly the top global commentary has been. And Anisha has done some digging and now joins in with the top global comments. Morning, Anisha.
Hi, good morning. Let me start with the hawkish commentary coming in from Fed Chair Jerome Powell, where he said in no uncertain terms, we believe there's more restriction coming. I wouldn't take, moving at consecutive meetings off the table. So that was the hawkish commentary coming in from Fed Chair, talking about how going forward there could be incremental tightening, incremental rate hikes that could be coming, because he continues to say that the road is long drawn and he'll have to inch towards that, bringing inflation back to the 2% mark. And he was not alone. Of course, hawkish commentary came in from ECB President Christine Lagarde as well. She said we're likely to hike again in July. Similar commentary coming in from Bank of England as well as Bank of Japan governor as well. But shifting focus to what the Fed member has to say, and that's about Bostic. He said that expecting inflation to last for a long period of time. It's only been 8 to 10 months that we have seen that the environment has been on a restrictive territory. There's time for waiting and watching what the effect of that tightening has been. But nonetheless, the road is not over and that journey towards controlling inflation really continues. So that's the word coming in. Lastly, just wanted to quickly highlight what's the latest coming in from Jefferies' Chris Wood. He's talking about his latest read and fear note, wherein they have increased the weightage of India and Taiwan by 1 percentage point, while that of Thailand as well as China has been reduced. So that, move away from China into India is literally what is really continuing. In terms of stock-specific action, Zomato's weightage has been increased by 1 percentage point. So that's interesting, while it's been cut for ONGC. So we're watching out for these stocks as well.
All right, Anisha, thanks a lot for that. Now, it's interesting that if one really looks at the YTD move here, why YTD move here? Nifty has done, frankly, just 5%. Yeah, 5%. But Tata Motor is up 50%. ITC is up 35%. Bajaj Auto, 28%. You've got Hero MotoCorp, which is coming back. And the sector which has really surprised everybody, at least in terms of a comeback, I think somewhere is autos. And what an unreal comeback it's for autos. That's one sector where demand, at least on the luxury end, has flourished. Demand in the non-luxury segment has been decent. CVs are doing okay. And the entire EV narrative, I think, has only got bigger. So the surprise comeback sector, frankly, this time around is autos, which nobody was expecting and nobody was anticipating. ITC, what a run it's been for ITC. The same company, pretty much the same fundamentals. 2 years ago, Aisha, all social media was abuzz with, ITC nahi ja raha hai upar, ITC upar nahi ja raha hai. Today, after the Sanjeev Puri interview, when I looked at my Twitter handle, everybody is saying, what is the next thing? This is the next multi-bagger in making. So now it's the pendulum which has shifted for ITC, really from ITC and Tata Motors, two stocks. If you frankly ask me, the two stocks which have surprised and have delighted everybody is ITC and Tata Motors. And that's what markets are. What looks hard, tough, which nobody likes, in 6 months the picture could be different.
But do you know there are actually only 2 stocks which are less than 1% away from their all-time high on the index?
One
Guess which
should
one?
be ITC.
No. It's L&T and Titan.
Oh, I didn't
Yeah, they're just about 0.5% away from their life highs. Their life highs on L&T was about 2433. If we can just bring up that intraday graph, and for Titan it was 3044, and currently they're scaling just about 0.5% away from those levels. So yeah, it's actually these two names which are closest to the Nifty life high. But four stocks are more than 40% away also from their all-time highs. There's ONGC, Coal India, Wipro, Adani Enterprises. These have seen some stark underperformance. And if you were to just map weightage-wise how the Nifty constituents are stacked up. So it's first Reliance, of course, which has the maximum weightage of 10.25%. That's 11% away from its life high. HDFC Bank is 6% away from its life high. Even ICICI Bank is actually away 2%. And then, of course, there is HDFC, which is up, 10% away. Infosys is 34% away. And ITC Nikunj is 1% away from its life high.
Yep. Aisha, there's no Reliance. There is no HDFC Bank. There is no Infosys.
No TCS.
No TCS.
Kotak Bank,
no
18%
Kotak Bank. And
away
markets have
from
made
its
an
life
all-time
high.
high. And that is what we must recognize, that courses they remain the same, horses they change. Nifty and Reliance not an all-time high. Nifty and HDFC Bank not an all-time high. Nifty and Infosys not an all-time high, but Nifty at an all-time high. Look at autos. I think auto dispatch numbers, we'll have to look at the expectations. Now tomorrow becomes very, very important from a market standpoint. Naresh, good morning. July historically has been a good month. If I look at the data in the month of July, 4 out of 5 times in the month of July, markets have gone higher. And they've gone higher even in that COVID year. Are we in for another good July?
So I hopefully think we'll be having a good July. And overall, if we look at the markets, we've made a new fresh all-time high. And we are yet to see, like you were discussing, yet to see leadership coming from majority of the Nifty 50 stocks. 6 out of the top 8 weights have not done an all-time high as such as of now. All of them are close. So overall, the structure is positive. To look at it in a simpler way, 18,600 to 18,900 was the range. That gives us a minimum target price of 19,200 to 300 in the extreme short term. And that is where we could be looking out for. So 19,200, 300 is the next price point where we watch out for some bit of a pause. But overall, the structure is positive. In the indices, Bank Nifty is coming towards a fresh all-time high. So it could be a time where some of the index stocks could actually make this move over the next few days, wherein we go towards this 19,200, 300 mark, cross 45K on the Bank Nifty.
Right. Good morning, Kunal. He's also joining us in the studio. And Kunal, let's just discuss the overall market setup. Yes, we're talking about how it's been nothing short of a splendid series gone by. And given the fact that we're now talking about 19,000 levels, etc., is your sense that the momentum is likely to continue?
Well, yes, it should continue, Avan. And the last 3 days specifically is a signal that the markets are trading into a very strong uptrend. So there were 2 days of correction, I think, previous week, where the markets corrected, where the Nifty corrected some 200 to 50 odd points. But then the way the Nifty has made a comeback, almost like a V-shaped recovery. More importantly, I think on Wednesday we had a gap up opening, and that gap was not filled for the Nifty. So that indicates that we've now established a new support on the higher side of 18,800 approximately on the Nifty. So I think keeping that as a support, I would expect the index to move up higher. So what happens typically is that when we trade into a band or into a range, the range gets replicated on the upside when you see a breakout. So we were almost into a 250, 300 point band of consolidation from the 18,880 odd mark. And if we try and add up that range on the upside, we could be looking at 19,200 to 19,400 as an immediate target.
Okay, let's find out what Naresh makes of individual stock ideas as well as the kind of move, Naresh, that we've witnessed on the Nifty Bank Index perched at near record highs. What's your outlook?
So on the Bank Nifty, going forward, what we need to see is support coming in from HDFC Bank, which is 25% of the index, and 2 weeks out, it should be 33% of the index, which is the maximum capping once the merged entity comes into place. So overall, once we do that, we could see a much sharper move. So the bias is positive. How much positive it gets depends on HDFC and ICICI, which are almost 50% of the Nifty Bank weightages. So 940 is taking up for ICICI Bank. 1700 crossing for HDFC Bank could be the fillip it needs. So overall, the bias is positive. Buy on dips continues. So positive on Bank Nifty. Stock specific longs, which I would suggest first is a buy on L&T. The stock is again trying to knock that all-time highs around 2400, 2430 levels. Clear relative strength in this move. Expecting this to continue towards a target price of 2600, stop loss at 2350. Second is a buy on JSW Steel, which is an odd one. The stock is now trying to make a all-time high after 6 to 8 attempts around that 780 mark. Clearly the leader in the metals pack. So out here, the first one to actually hit a new all-time high in this whole sector. That could create some momentum towards 840 in the short term. Stop loss at 760.
All right, let's get Kunal's top stock ideas. Kunal, what's on your radar this Friday morning?
Well, I'm tilting towards the large cap pharma names because I think Sun Pharma on Wednesday showed very good price action as well as volume move. The stock is now confirming a breakout of an inverted head and shoulder pattern, which I believe could be extremely positive for the stock over the near to medium term. So would suggest a buy on Sun Pharma for a target of 1080. Stop loss could be kept at 980 mark, and IndusInd Bank is the stock which I would suggest is a buy, trading at 1335, very close to its previous swing highs of 1340 approximately. So would suggest a buy on IndusInd Bank for a target of 1400 approximately and stop us at 1305.
All right. AMC stocks, there would be a relief rally there because the Sebi chairperson has clearly said that what we are considering based on the feedback is going to be significantly different than what the initial buzz or the initial recommendations were. Mutual funds, they charge what is called as commissions from investors or unit holders. Over the years, because of scale, size, efficiency, Sebi, the regulator, has argued that it needs to be curtailed as the efficiencies is something which will benefit the profitability of AMCs, and TR has been coming down. But if TR comes down, really understand, foreign shareholder, if you're an investor in some of these stocks and few of them are listed, the profitability comes down. And AMC stocks, frankly, in last couple of months have really underperformed. So let's look at AMC stocks. I mean, we're talking about a big bull run in SIPs, talking about a big bull run which is fueled by Indian investors. But AMC stocks, well, HDFC AMC this year done nothing. Birla AMC, it went actually below its listing price also. That's Aditya Birla Capital. We're looking at Aditya Birla AMC, that's a separate company. This year, Aditya Birla Capital has done something different, largely because of change of management there. But Aditya Birla Sun Life down 19%. Then you got UTI, where there is a buzz that where there is a buzz that there could be change of guard. But UTI AMC, despite that buzz, is down 15%. So Naresh, could there be a bounce because of the news in some of these beaten down stocks?
So in the near term, they've bounced back, and ideally, given the announcement, there should be some bounce back. But it would be difficult to trade it because they'll gap up in a, say, way where the risk reward does not make it interesting. But overall, long-term structure still is weak for the whole sector as such. So for a HDFC AMC, 2300 would be a tough task to cross. UTI AMC has been down all through the cycle. Nippon is the only one which looks interesting because that is where there has been some base formation. And the stock went back almost to March 2020 lows and has recovered. And there is a dividend deal play here as well. So technically, if one has to bet in this sector, Nippon Life looks interesting, where the stock has corrected the most in terms of a fall all the way to March 20. So from here on, say this is a stock which will go towards 300. So would look at Nippon Life AMC.
All right, time for a quick break right here on the show. And as we do that, let's hear it out then from top market veterans, the likes of Atul Suri, Vijay Kedia and Samir Arora, sharing their outlook on the view on the journey towards 1 lakh for the Sensex.
I haven't done the maths, but why not? Really, why not? It's just basic compounding. It's going to get there, yeah. You know, having been in the market for 30 years, I saw the Sensex at around 1,000. So that's like what you're talking about is a 50, 55, 60% move. So I'd see that there's no reason.
Because I don't invest in any Nifty stock or any Sensex stocks and all. So when I talk about Sensex, that means I'm talking indirectly, I'm talking about my portfolio. So whether index doubles from here or not, that is a different issue. But I expect that this mid caps where I am investing, not I am in the general mid cap category, good stocks should double or triple in next 2-3 years time. And so far index is concerned, I think that index is a counting of 21 is happening index 21,000, 42,000, 63,000. And I think that next stop should be 84,000 in 2 years from now. And of course, 100,000 is just a destination, I think, and miles to go for index.
So for that, my simple thumb rule is compound at about 13-14% and see whether 1.14 to the power of 5 into 66,000, does it become 1 lakh or no? So plus minus it would be there. Because broadly speaking, if I look at it over any reasonably longer period, the returns have been in this range. So, it doesn't need too much of rocket science. That's why I tweet saying you want 2 lakhs, you just extend the number of years. Because broadly speaking, this number doesn't come only from the fact that historically this has been the range over last, I saw it over 3 or 4 periods, which is 5-7 years. And then I think I did 14 odd years and then some 20 years and then my own my career, which is about 26-27 years, and broadly over every period it is in this range. But this range is not just coming by looking at historical numbers, but by the fact that Indian GDP in rupee terms grows about 11-12%, and then you can add 1 or 2 more percent for the fact that corporate sector might be doing better than the rest of the economy, or you might be doing it from an equity risk premium point of view, that equity returns are normally 5 to 6% more than the fixed income 10-year type return of the same country's government bond. These are all worldwide things. And also broadly, we feel that for a large part of the corporate sector, the earnings growth for normal, once they become a little, this thing is in the range of 12, 13, 10, 15%. And then some companies grow at 20-30% for some periods of time. So from all angles, it looks that is the thing. So you just multiply and see, but I would think it would reach somewhere there.
Back with the market right here, Niti. Now take a look at the SGX Nifty. While adjusted for a day's break, it's already indicating a very solid start for us. Right now, it may be just mildly up in the green, but it's a good 100 point from where we left it off on a Wednesday in trade. 19,174 on the futures. But let's talk about individual stocks in KPR Mills. That's going to be in focus on the back of strong Pharma Q3 earnings. In fact, the multinational fashion retailer has posted a 13% revenue growth this quarter. What does this mean for KPR Mills? Let me take it across to Vinny and find out exactly that. Vinny?
So, yes, we are keeping an eye out on KPR Mills today because Primark reported its numbers, and strong quarterly results is what the company has reported. 13% growth in terms of revenue for Primark. On a like-to-like basis, the growth was at 7%. The growth was mainly driven by seasonal clothing and accessory categories, what Primark highlighted. And they said the UK and Europe were the key growth markets for Primark, which grew by 6 and 7% respectively on a like-for-like basis. What Primark is, mainly why Primark earnings are important for KPR Mills is because KPR Mills, around 65% of the exposure is from the European markets. So because of that, we're keeping an eye out on KPR Mills, and Primark is one of the largest value garment retailers in UK as well as Europe. So it gives us a fair indication of how the demand trends are shaping up over there. And that is why 65% of revenues for KPR Mills comes from Europe market. So that is why keeping an eye out on KPR Mills, and Primark is one of KPR Mills' major customers as well. So obviously that significant indication of a positive sign and result and growth seen by the customers means positive cues coming in even for KPR Mills.
Thanks very much for giving us those details there. Didn't know that there was that link actually between Primark and KPR Mills. But let's move on. Lots of other stocks as well that are in the news. And MCX, the company has extended their support services contract with 63 Moons for another 6 months. Let's understand what the implications are of this software support services contract. We've got Sharad here with the details. Sharad?
Well, yes, in focus we are having MCX, an important development coming in. Now there is an extension of the software support program coming in from 63 Moons Technology, and do remember this will be there for the next 2 quarters. That means next 6 months. Now per quarter the transaction amount is expected to happen at around 125 crore rupees versus the earlier price which was being paid at almost 81 rupees per quarter. Now what's the impact on MCX? It's expected to be an adverse impact of 250 crore rupees hitting the PL in FY24, and also the cumulative payout to 63 Moons has already been 472 crore. Now overall, to give the perspective, there has been a delay when it comes to the implementation of new trading platform which should be done by TCS themselves, and the brokerage have stated that the payout which is expected to come for 63 Moons is actually higher than the capex which should be there for the onboarding of the new software. Now brokerages have given certain downgrades to the stock. Investec has downgraded the stock to hold from buy, cutting the target price from 1780 rupees to 1715 rupees, and they have significantly downgraded their FY24 EPS numbers as well. Morgan Stanley has maintained their underweight rating with a target price of 1125 rupees per share. As for the Bloomberg consensus, also the 12-month target price is coming in at 1560 rupees per share. However, recently the stock was on a rally and going up almost 24% from May lows.
Right, and on to some fundamental ideas then. Here's Chakri Lokpriya telling us why he's now positive on the pharma sector.
The pharma as a space is clearly which we have not focused on, but in the case of Sun Pharma, they separated out their research division, so they created some amount of value, and they moved down the vertical chain in terms of making their generics more complex, which gives them some amount of margin protection. And that also gave them some amount of pricing pressure as far as the US markets is concerned. So I think some of the steps taken by Sun were company specific, which clearly helped in the stock performance.
Okay, let's move on then. BPCL in the spotlight. This is on the back of their 18,000 crore rupee rights issue. Why is the street exactly cautious about the refiners' fundraising plans? Let's get in Somit. He joins in with all the data to put that into perspective. Somit, why is it?
Well, the 18,000 crore fund issue has been approved by the board, but the details are yet to come related to the issue price, entitlement ratio, the record date and the timing of this announcement. Now, this rights issue has been done to enable the government to infuse funds in the company, which was already approved in the budget. They had said around 30,000 crore would be infused in all the 3 oil marketing companies, and to enable this fund infusion, the board has decided to go ahead with this rights issue. But why is this rights issue negative for the company? Firstly, because the company actually does not need any fund for the capital expenditure purpose. Their internal accruals would be easily available to fund their capital expenditure. Also, given the fact that the cash flows are strong and the leverage continues to remain on the lower side for BPCL. Now, if you see this rights issue, now this rights issue is kind of EPS dilutive for the company at current market price. If they do go ahead with this rights issue, then the FY25 earnings would be dilutive by around 12%. But usually rights issue happen at a discount, and if the discount ranges around 10 to 30%, then the FY25 EPS would be dilutive by around 14 to 18%. And the street continues to believe that a viability gap funding should have been done by the government other than this new share capital issue that the board has chosen for. Now, along with this, the street is also fearing that given the high marketing margin, the fund infusion was not required. The high marketing margin was sufficing for the losses incurred by the oil marketing companies in financial year 2023 due to unchanged retail fuel prices. So going ahead, the street is fearing that will the government ask the oil marketing companies to now start cutting fuel prices, which will directly impact the earnings of these oil marketing companies going ahead. Also, given the fact that the election period is starting and the marketing margin continues to remain at the higher side, nearly 3 times more than the normalized margin that the oil marketing companies used to earn. This is the bigger fear for the oil marketing companies.
All right, Somit, thanks very much for giving us all of those details. So that'll certainly be a stock to watch out for on the back of its rights issue and the cautious stance by investors. Tata Communications, meantime, will be in the spotlight today on the back of an acquisition where the company is buying out CPaaS player, that is Kaleria, in a $100 million deal. Somit only joins in with the details. And Somit, what exactly are the contours of this deal? What does it bring to the table for both parties?
Well, 100 million is what Tata Communications is going to pay for this acquisition. This acquisition is expected to complete in the next 6 to 9 months. Now, it's a CPaaS player, which means that it does exactly what Route Mobile does in India. This company does it in US, India, and in other geographic areas also. Now, if you see the gross margins of this company stood at around 21%, but on the EBITDA front, it was a loss-making company. Its gross net debt stood at close to $150 million US. Now, what foreign brokerages have been saying about this company of late, if you see amid macro uncertainties, the company is facing pricing pressure, longer sales cycle and slower volumes. Its leverage also remains high. The net debt to EBITDA is at around 6.5 times, and the second quarter's calendar year 2023 revenue guidance implies a growth of just 1%. However, the company has reiterated their EBITDA growth guidance of around 20% and they're saying that the company will start making free cash flow before that debt repayment. On the valuation front, the stock is listed in US and it traded around $4 per share value, but Tata.com is paying around $7.25 per share, but compared to the last 6-month average, it is at a premium of 25%. However, do remember that this company had acquired M-Engage in 2021 for around $215 million US, and right now Tata Communication is getting the entire company at just $100 million US. Also, the deal is valued at just 0.7 times EV to sales as compared to 2x valuation given to Root Mobile in India. Also, Tata Communications focus going forward is to EBITDA break even in the near term and to see a double-digit EBITDA margin over the medium term.
Okay, Somit, we'll leave it at that. Lots to discuss. Let's welcome on board then Dipan Mehta and talk about what he's making of the market right now. Dipan, hi, morning. Great to have you on the show. We were just looking at the all-time data. It's quite surprising that none of the Nifty constituents are actually all at their all-time high. I mean, closest is L&T and Titan, and they too are away 0.5%. And ITC, by the way, is 1% away still.
Yeah, that's right. I think I was also hearing your analysis. First of all, good morning and thank you for having me on your show. I was also hearing the analysis, which was quite interesting. And the first thought which came to mind was that, wow, if so many Nifty stocks are so many percentage points away from that high, I think that much more space and room is there for the Nifty to move up from these levels as well. So we are nowhere near the top. And maybe I think once this particular new high is established and we cross the earlier ranges, then I think the markets can move up even higher from these levels. So I think it's good tidings. And let's just hope we're able to build on these gains.
Why is auto, Dipan, going through such a strong purple patch? I mean, is there a reason which we are missing on? Because frankly, if I look at the dispatch numbers, they are growing, but it is not they are growing exponentially.
Yeah, Nikunj, good morning. See, we are just seeing the volume of growth for the auto sales. But what point we come to know only in the quarterly result is the increase in the average selling price. And that is moving up 10-12% year on year every quarter. And the reason for that is premiumization, which is taking place within the space. I think what all auto companies, two-wheeler, four-wheeler, even commercial vehicles, what they have done is that they have beefed up their product offering. New products are being offered more frequently than ever before. New variants are being offered, and they're just taking the entire consumer up the ladder when it comes to premium products. And premium products are generally at a higher value. They provide a higher operating profit margin also to the auto industry. So even if you have a single digit type of a growth rate, 8-9% volume growth, that's enough to generate a 15-16% type of a top line growth on terms of revenues. And that could lead to 20% type of a growth at the profit level. And that's, I think, what is keeping a lot of players interested in the auto industry. Also, I think after many, many years of stagnant sales, we are seeing an uptick in the sales growth for the auto industry. And these are mildly cyclical businesses as well. So I think we are seeing a good cyclical upswing in the auto industry. And that also, I think, is attracting a lot of investors.
Okay, I'm just going to, talk about a theme, Dipan, which in a sense is obvious, but stock markets are saying no. AMCs. The Sebi chairperson has said that the TER, which markets were expecting and what was discussed initially, is not going to be implemented, which means that there could be a relief for AMCs. Is it a good time to buy into AMCs? Because if India is rising, SIPs are flowing, mutual funds are here to stay, then obviously the future for AMCs, it may not be this year, but for next 5 years will be very bright.
Yeah, Nikunj, I tend to agree with your argument, but this constant changing of regulation for the AMCs is what doesn't give comfort. And this entire TER goes to the absolute vortex of what revenues that these companies can earn. And on the whole, also, I think that more and more players, investors are going towards AIS, portfolio management schemes, as well as these new fintech, new generation fintech companies. So from that point of view, there is a lot of tough competition for the asset management companies within the AMCs. Also, there's a lot of tough competition. And then there is this entire kind of assessment that by and large mutual funds are not able to beat the underlying benchmarks on a consistent basis. So I think that while optically you're right, I think in a growing market where equity prices are moving up, their revenue should go up. But there are too many moving parts are there, and this entire Sebi, whatever policies or whatever fee structure they decide for the industry, that's a big dangling sword. So keeping all of that in mind, I want to avoid AMCs. Their track record has not been that great over the past 3-4 years or so as well. And I think within the financial services space, we prefer a company like 361. Earlier it was IIFL Wealth. Again, a disclosure, we and our clients are invested in it. And I think that company has got a great future and fantastic prospects as a wealth manager. Considering that they are not dependent on any one particular asset class and they focus on the HNIs and the ultra HNIs, whose numbers are fast growing up. So very positive on wealth management companies. Anand Rathi Wealth also, I think we haven't studied it closely, but look at the numbers which are coming through from that company as well. So within the financial services space, we prefer the wealth management companies rather than the asset management companies.
It is just not a coincidence that today Citi has come up with a big report initiating a buy on 361, that's IIFL Wealth, headed by Karan Bhagat, and what a franchise they've created. Then you've got Prudent, which also is again a big distributor. That also has been, see, you can't look at the 1 year change because there is a stock split element there, so please take it out. But in general, their view on 360 One-Way Limited, Wealth Limited is that it could be valued at 600 rupees and it could see an EPS CAGR of 15 to 20% for next 3 to 4 years. That's reasonable. Look, it's very simple. I'm just going to break it for our viewers. In India, the wealth creation journey, I think, has started. And there was a time when you would save all your wealth in cash or in real estate or in gold. But that entire approach has changed. Now, India, as it is growing and Indians are getting richer, they are also diversifying their savings. And that is coming back in financial assets. Also, the financial markets have become big. The startup market has become big. The debt market is evolving. Mutual funds have become easy. There is KYC. There is a digital stack which is ready, which means that right now, as India will grow and as the saving and the per capita will expand, the option to invest outside the comfort of, let's say, real estate, land, flat, building and gold, I think is evident. And that's where some of these wealth managers, I think, would really be disproportionate beneficiaries. Up until now, these entire wealth management businesses were only managed by large banks. They, in a sense, had a huge amount of advantage because of the distribution network. But like Dibin just said, an Anand Rathi, a 360 Wealth, you've got Prudent. There are a lot of these wealth managements which are homegrown and have now become a force to reckon with. So I will not be surprised that if this, which is a small space, really could be a powerful space for next couple of years per se. I'm going to change gears and go back to Nuresh and talk about another theme which now is catching up, and that's insurance. And Nuresh, good old insurance stocks in the month of June have made a comeback from an LIC to a Star Health.
So this has been one of the most surprising ones in terms of a recovery, the whole insurance segment. Say after the budget, the stocks fell with a big gap down, made another low in March, and now the recovery has been very sharp. So it makes it a little difficult to trade here. Actually, in the short term, something like a HDFC Life where the blocks are over, looks like a short-term top is done and we go back and retest the last breakout of 620. But the rest of the names, ICICI Pru looks interesting, which is where the stock is coming back to the previous highs. Again, out here, the recovery has been way too sharp. So a lot of these names have gone much beyond the budget day highs. So the risk reward is not great. The only stock which is left, the two stocks which have not done a big catch up is Max Financial Services. That also moved up in the last 1 week. And the good old Life Insurance Corporation of India, which has not done much. It corrected in the last 3-4 sessions as well. So if somebody is looking out for a player, it is only LIC of India which is there left from 620. This is the only stock which can give an upside of 10-15%. But the rest of the names in the near term could actually be topping out. So first preference would be LIC, next would be Max Financial.
Right. You know, a lot of these stocks which are going to be in focus this morning, and look out for what ICICI Securities as well may do, considering ICICI Bank has now approved the draft scheme of arrangement for delisting by issuing 67 shares in exchange of 100 shares of ICICI Bank. This, of course, is going to be positive for the shareholders of ICICI Securities to be getting ICICI Bank shares. The other pocket, of course, is after the GQG recent buy into the Adani names. Adani Enterprises, Adani Ports, all these stocks have been holding up very smartly. But Kunal, still a long while away from their all-time high, right, for the Adani names. And I'm going to pick up on Ports and Enterprises. What do you read on the charts after the recovery that they made from the Feb lows?
Yeah, I think significantly away from their life high levels or the all-time high levels for these stocks. But then there are two aspects to look at it. That the markets have clearly distinguished the group of stocks within the Adani pack, which have shown signs of stability as well as comeback. So I think in that regards, you have Adani Enterprise, Adani Ports, the cement stocks, ACC Ambuja Cement. These stocks have made a very good comeback for themselves from their January end, February start lows for themselves respectively. On the other hand, the likes of Adani Total Gas, etc., these stocks have been languishing and they've not been able to lift off or recover themselves from their from the initial selling in the month of January. So the markets have clearly distinguished the kind of stocks which can make a strong comeback. Even on the very short term charts, for example, Adani Enterprise. I remember, I think from 2,300, 350 odd levels, just about a week odd back, the stock made a V-shaped recovery where the indicators were oversold. So when a chart like Adani or high beta name follows those classic rules which we define for technicals, that indicates that it's still moving in a very systematic kind of a manner. So I would probably expect Adani Enterprise, Ports, Ambuja Cements, ACC as better candidates from the Adani pack even at current levels.
Dipin, is there a specific reason why Pharma is going higher?
Yeah, I think partly it's cyclical, considering that for many, many years, I would say not many years, but many quarters, I think the best time for Pharma was just around the time when COVID was peak. Thereafter, they have been in a kind of a downward swing. But base effect, overall demand catch up, and new product launches, domestic market, global markets, in some instances, blockbuster, export-oriented molecule where there is limited competition. I think all of these factors have played towards better earnings for the pharma sector. And I do feel that maybe next couple of quarters also may be decent. There's good momentum behind these companies. But on the whole, when you look at a longer term time frame, 2-3 years down the line, I don't think that companies which are got say 25-30% of sales coming in from US, 40-50% revenues or 60% revenues coming from overseas markets are that great a bet at this point of time because of continuous price erosion over there. Our preference is for companies which are focused on the domestic market. 3 companies come to mind, usual disclosure: Mankind Pharma, JB Chemicals, and Eris Life Sciences. I think they're totally focused on the domestic market. And these are the kind of new FMCGs. They focus on brands. They focus on creating a kind of a loyal customer base for their molecules. And that's what I think drives growth. And from time to time, they do make new product launches as well. So very positive on these 3 companies. And then there are the contract manufacturers also. I'm not completely so negative on Divi's Lab at this point of time. I think the worst may be behind them. Give them a couple of quarters or so, and we should start seeing a decent upswing in their performance as well.
I'm just looking at, the primary market as well. And Dipan, pretty lively all of a sudden, right? A lot of IPOs are now hitting the market. Idea Ford seems quite interesting. The overall subscription numbers so far at least also are looking extremely great. Have you taken a look at this one?
See, whenever a new IPO is coming, I just quickly look at what the price to earnings multiple they are offering it at. And for Idea Ford, it is 87 times. So I did not read anything further. So, as a general rule, I don't want to buy anything which is more than 50 times. I mean, whatever maybe the maybe the business model, especially at an IPO level. Let's see, after 2-3 quarters, 1 or 2 years down the line, when the company settles down, the trading is more on an average basis, and there are no longer these considerations of the IPO, then what multiple it is available at. So from that point of view, I'm generally avoiding IPOs. As I said, I think Idea Forge per se looks very expensive to me on the face of it. I mean, for the company to grow at 50-60% consistently for next 3 to 5 years, it will always be a challenge. And there are execution risks over here, there are technology risks over here. So keeping all of that in mind, the risk return profile doesn't favor buying into a stock like Idea Forge. But I can tell you, I'm sure it will get heavily oversubscribed, and even more certain that it will list at a very good premium. So there is, of course, an opportunity, a trading opportunity over here. You can flip the stock afterwards. But from a longer term investment perspective, I'm not sure.
Well, 30th of June, last trading day of the quarter, last trading day for the month, and last one for the week. How will July be different? That is what I think is important. Now, historically, if you look at the seasonality in the month of July, Nifty has declined only twice in last 11 years. Wow. And even in the COVID year, in the month of July, because you're coming up from that base, markets actually went up. Now, data is data. And the data tells you that July is going to be another strong month based on historical data. What would be the differentiating factor for July? Factor number one, earnings season. June was all about liquidity. June was all about FOMO, and a lot of small cap stocks saw compulsive buying. July, that may not be the point. Second, July, the monsoon progress would be very important. Now, we may look out of the window if in Bombay and Delhi and say, okay, thank God it's raining. But the rainfall distribution is something which will only be clear in next 2 or 3 weeks, and purely from a market standpoint, because you are at that position where the vegetable price inflation, the cereal price inflation has started kicking in. Tomato has gone to 120 rupees. Rice and wheat prices have already shot up. There's a water shortage in Mumbai already, we know that. So there are these factors which may really be the irritant for the market. And third, it's going to be good old Fed. I mean, they've said that another rate hike cannot be ruled out. Another rate hike means that last time they hit a pause button, will they consider rate hike? So these are the three differentiating factors between June and July. Earnings season foremost, progress of the monsoon. Because, liquidity and technicals, they were at play in June also. So you cannot really say that they're differentiating factor. For me, that really is the differentiating factor. Now, it is flip of a coin, but sometimes it's good to flip a coin. The good old adage was, in the month of May, sell and go away. Guess what? If you did not sell in the month of May and you just remained put, it's been a good quarter for you. Now, historically, July, 2 out of 11 times has given positive returns. Will July of 2023 be different?
I see no reason why July 23 will be different. I have always maintained this theory that whenever it is raining outside, stock prices always are doing well inside over here. So I have no reason. I have some sense of conviction on this theory. And the reason is that I think a lot of money which is not generally used in working capital does get deployed into the stock market on a short-term basis, which is what takes all equity prices higher. But nonetheless, I think we are in a good zone at this point of time. And the earlier problems about inflation, interest rates, Fed tightening, central banks tightening, those are now behind us. The geopolitical event also, I think, has been largely discounted. Commodity prices have truly come off, and inflation is well under control. Now we are looking at the end of this particular cycle, and who knows, maybe a year down the line, you could look at lower interest rates from the central bankers as well. At the same time, I think, the entire India economy is chugging along pretty well. We're going to have an election season in 2024, and that's certainly going to put more money in the hands of people and boost consumption as it always has. And on the whole, earnings are looking good for companies. So while you may fret and fume about valuations, I think equity prices are poised to move higher and higher over the next, not just in July, but for the next, I think, several months or so.
Some stocks within the broader markets that have managed to cross the 200 DMA within the broader universe. There's names like a Quest Corp that has done quite well on the charts as well. The kind of price action that you witnessed on Wednesday's trading day. There was a Praj Industries as well that crossed its 200 daily moving average. Adani Ports, another case in point, and you also had another name added to that list, and that's a UTI AMC. That stock as well crossing its 200 DMA. In fact, Kunal, curious to get in your take on some of these movers: Quest, UTI AMC, Praj, Adani Ports above their 200 DMA.
Yeah, so many of these stocks are making a very good comeback. So, for example, we discussed Adani Ports and that how these stocks have made a good comeback from their respective January, February lows. Even the likes of Praj, I remember, I think there was a point where Praj Industries moved in line with most of the traditional sugar names. But in the last 6 odd months, 1 year approximately, the stock has gone a lot more sideways. The correlation seems to have broken. The stock, was persistently trading below the 200-day moving average. In the last 1 or 2 months, specifically from the March lows, it's made a good comeback. And I think the stock was at 300 or sub 300 levels in the month of March 2023. And it's now come back towards the 378, 380 mark. So which means that it's made a very strong comeback. The last 2-3 months, we've seen many of these beleaguered stocks who were trading in a range, in a more of a broader range. These stocks have either made a good comeback or at least they've recuperated the losses which these stocks have shown over the last 1 to 2 years. I think that's the sign of this or the strength of this strong bull market or bull phase for the indices, that many of the beleaguered stocks, the stocks which were trading into a range, consolidating, breaking down, these stocks have made a good comeback. Just as an exception from different from the names which you mentioned, Pharma, the stock which was almost at 400 rupees, is now come back towards 700, 720 plus levels. Again, a stock which was beaten down significantly over the last 1 to 2 years, made a very strong comeback. So I think that's the strength of this bull market. It's not the traditional leaders or the winners which have led the markets up, but it's also the underperformers which have made a very strong comeback.
Okay, that's the view coming in on some of those stocks that have seen a decent breakout then on the charts. Meantime, curious to get in your take, Depan, as well as to what the outlook is on some of these auto stocks. We spoke about the kind of dispatch numbers, but would you believe that even there is, opportunity within auto ancillary companies as well, some of the tire companies, etc., battery?
Yeah, I think if auto OEMs are doing as well as they are and they are moving up the value chain, then that is very positive for the auto ancillary companies as well. And we prefer companies which are focused more on the infotainment, on security, on better interior, all of the characteristics in a vehicle which increase the premium value. And companies, I think, which are engaged over there, which have got no threat from EVs, are companies like Sona, BLW. Then you have Uno Minda, as well as Minda Corp. I think 3 companies certainly come to mind, and there may be many others as well. So we generally prefer companies which are in the electronic space rather than the engine part space. Coming specifically on tires and batteries, I think they're benefiting tremendously from lower commodity prices. And overall, I think as and when the economy and transportation starts to do well, the replacement market and replacement demand also kicks in for both these sectors, and that also is very positive. The problem with batteries is that longer term, the EV threat is keeping the price to earnings multiple under check. And when it comes to tires, the excessive capacities which are getting created, that also is a kind of a risk factor. But by and large, I think next 3-4 quarters look exceptionally good for auto OEMs as well as auto ancillaries.
All right, there you have it. That's the view coming in on some of the auto ancillary stocks. In the meantime, let's check in on what the pre-open rates are indicating, kickstarting a brand new series as well as at the end of the week, given the fact that we were at those all-time highs at 19,035 on the Nifty, with the Sensex at around 63,790 levels. Let's find out what it is that our chartists are picking out as their mid-cap stock calls. Naresh?
So that would be a buy on Relicare Enterprises. The stock gave a breakout yesterday with good volumes in the last 2 sessions. The previous all-time high for the stock is around 190 to 200 zones. Stock is making a classical cup and handle formation, which has a breakout above those levels. So for now, expecting a move towards that 190 to 200 mark. A stop loss to be kept at 170.
Let's quickly get in Kunal's top mid-cap call.
That'll be a buy on PFC. Very strong momentum for the stock, at least over the recent charts. Targets 225, stop loss at 214.
All right, those are your